All right, we're going to start with about 3 or 4 minutes where on a blank sheet of paper, I want you to, one, draw a correctly labeled aggregate supply, aggregate demand model of an economy in a recession. Two, give me two fiscal policies that the government may enact to bring the economy back to full employment. And three, suppose the fiscal policies you suggest in part two are enacted, show the shift on your aggregate supply, aggregate demand graph from part one. Okay, so here we have our economy in a recession. The equilibrium point is below or to the left of the long run aggregate supply, the natural rate of output, the full employment output. The two policies, the government could decrease income taxes and increase government spending. If that were to happen, we know that consumption and government spending would increase, and it should shift the aggregate demand curve to the right. And if it brings us back to full employment, it should shift us to that point right there. We'll call this AD2 and AD1. We're going to show the shift to the right. We're going to show the increase in GDP and the subsequent increase in price level. Today we're going to talk about chapter 26. It's on the money multiplier. The first question is, how do banks make money? Banks make money by loaning out your deposits. A lot of us have this idea of a bank as they just take your money and they put it in a vault. That's sort of like what, when you're growing up and you're watching cartoons, that's how what banks work. They just hold on to your money. But that's not the way that they work. Banks take your money and they're going to loan it out to other people that want to open businesses or buy houses or buy cars. And they make money by charging interest on those loans. So the bank isn't just sitting with a vault full of your cash. All right. In fact, if you think about the money in your bank account, the bank really doesn't have all of that. If all of us went to the bank and withdrew all of our money, not everybody would be able to get their money, which is a scary thing to some people because a lot of that money is being loaned out to other people. The money that banks do keep are called reserves. Reserves are deposits that banks have received but have not loaned out yet. Deposits that banks have received but have not loaned out yet. It's the money that the bank is actually keeping in the bank. In the United States, we have something called a fractional reserve banking system, where banks are only required to hold a portion or a fraction of the money that you have deposited. The rest of the money they lend out to the people who want to buy cars, go to school, open new businesses, or buy homes. Right? So only a fraction of your money is actually kept in the bank. The rest is loaned out to people seeking loans. The reserve ratio is the fraction of deposits, sometimes it's expressed as a percent, that the banks are required to hold by the central bank, or in the United States case, the Federal Reserve. In the U.S., the current reserve ratio is 10%. So think about that. That means that the money you have in your bank account right now, the bank is only legally required to hold on to 10% of that money. So if all of us went to the bank at the exact same moment and tried to withdraw all of our money, only about 10% of us would be able to get the money. The other 90%, the bank won't have that money until people start repaying their loans. All right? Which is a scary thought, but obviously it's not really going to happen. Everybody's not going to ask to withdraw their money on any given day. Generally, the amount of money that comes out of a bank is equal to the amount of money that's being paid back in loans. So banks are okay with only keeping 10% of the money as a reserve requirement. The reserve requirement is set by the Federal Reserve in the United States. The reserve requirement are regulations on the minimum amount of reserves that a bank must hold against its deposits. Now, it's a minimum, a hard minimum, meaning you cannot go below 10% in the United States. That doesn't mean that you have to loan out 90% of your money. You can keep what they call excess reserves. What this means is that when the Federal Reserve creates extra money, and that money goes into the system, when they're increasing the money supply, it increases by a much larger amount than the new money produced. Like this picture. The First National Bank gets $100 in, say, new deposits. Well, if the reserve requirement is 10%, they only have to hold on to 10 of those dollars, which means they can create $90 in new loans. Well, what is somebody going to do with that new loan? I don't know, spend it on a brand new house or a brand new car. But either way, they're going to spend that money and it's going to become somebody else's income. When it becomes that person's income, they put it into their bank as a $90 deposit. And then that second bank is allowed to loan out $81 more. That $81 is going to be spent and become somebody else's income and go into another bank. So that initial $100 of new money is going to create a lot more than $100 because of the number of times that it goes through the banking system and is loaned out. So let's take it through a couple of iterations. Let's go through a couple of banks and just go through the numbers. All right. Now, we see that in this example, each bank is loaning out the maximum allowed under a 10% reserve ratio. Banks don't need to do this. They don't need to lend out all the money they are allowed. They can keep these excess reserves. They can't keep more money than they need to. But let's just look at a banking system where all banks are loaning out the maximum amount of money. Let's start with the initial $100 deposit. Bank 1 gets $100 of new money that was printed by the Fed, and the Fed gives it to Bank 1. Not exactly the way it works, but let's just go with that for now to see how this money multiplies a bunch of different times. They have to keep $10, they loan out $90. That $90 gets spent, gets put into Bank 2. They have to keep $9, they can loan out $81. That $81 gets spent, it gets put into Bank 3. They're required to keep $8.10, which means they can make additional loans of $72.90. That $72.90 gets spent and put into Bank 4. Bank 4 has to keep $7.29. They can increase their loans by $65.60. That $65.60 goes into Bank 5. Bank 5 has to keep $6.56. And you can see that it keeps going on and on and on. And all of my calculus BC people in the room are thinking, oh, this looks a lot like a converging sum. All right, which is this number is going to keep going down and down and down. It's going to happen hundreds and hundreds and hundreds of times until we're talking about pennies and fractions of pennies. So if it's a converging number and it eventually gets so small that it's fractions of a cent and we're not even talking about loans being made anymore, now all of a sudden that lets us know that we can find a finite number, an actual number for the total of loans that can be created by this initial $100 of new money. And that's where the money multiplier comes in. The money multiplier is 1 divided by the reserve ratio. 1 over the reserve ratio. So with a reserve requirement of 20%, the money multiplier is 1 over 0.2 or 5. In our example, the money multiplier is 1 over 10% or 0.1 or 10. So what that means is the initial $100 that was created is going to create $1,000 of new money. That $1,000 breaks down into the $100 that was initially created by the Fed and $900 of loans that the banks create by being able to loan out 90% of their new deposits. So the 3 important takeaways from today are the reserve requirement is the percentage of every deposit that a bank must keep or that they cannot loan out. That excess reserves are extra money a bank keeps above and beyond what is required by the reserve requirement. And that the money multiplier is 1 divided by the reserve ratio. From this chapter, I'd like you to read pages 664 through 668 and 679 through 680. Then I want you, in groups of no more than 3, to complete the classwork, homework shown on the board. Your sub tomorrow will collect that homework assignment. Have a good day.